Welcome to Cherry Becker's Technology Podcast. My name is Michael Valerio, and I lead the firm's tech and life science practice. I'm pleased to be joined here today with Brian Dill, who leads our international tax practice, and we'll be discussing the potential impact the new upcoming administration may have on tech businesses with global operations. Brian, thanks for joining us.
Hey, Michael, thanks a lot. Glad to be here.
So let's start with what we've been asking by our clients lately. What are some areas we should be paying attention to when it comes to the new administration? We assume some new tax policies will take place that'll affect tech companies here in the U.S. that have global operations or employees overseas.
Yeah, I do. I think what you've been hearing is tariffs, 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 and I think people automatically think about manufacturing industry and not the technology industry. I think the tech industry needs to be really tuned in to what the new administration is doing from a tariff perspective, not directly in the tariffs, but indirectly what's going to happen. There are these, from a foreign perspective, not a US perspective, there's these things called the OECD, the Organization for Economic Cooperation and Development. And they have this new tax model, and it's a two-pillar model. And I know a lot of you have heard of Pillar 2 and the 15% global minimum tax, but the other is Pillar 1, and that's a fundamental shift of where companies would pay tax. And essentially, it would be more where the consumer is located. And given that the tech industry is predominantly driven out of the US, the global leader by more, I think the Trump administration believes that politically, OECD Pillar 1 and Pillar 2 is just a way for other governments to get a slice of the technology pie through revenue. And what I mean by that under Pillar 1 is that companies would start to pay tax based upon where the consumption is occurring, based upon a percentage of their profits under Pillar 1. For example, if technology company ABC in Silicon Valley started to sell digital products and things to, let's say Italy became a big consumer, they had a big consumer market there because it was used there, all of a sudden, and it makes up 15% of their sales, or then potentially up to 15% of their profits. Tech company ABC, even though they do everything here in the US, they could start to have to pay tax in Italy up to 15% of their profits at that particular rate. Now, what has occurred is that under the Biden administration, they were like, that's a no-go. And there are 30 major countries that would have to sign on to Pillar 1. And certainly before the election, it was not looking positive. But after the election with the Trump administration, I think Pillar 1 is dead as a doornail. However, what is not being stated is that governments want to do something, right, to raise revenue and do not think the tech companies are paying enough. So that's where you hear these digital service taxes. So that if you're selling into a country digital services, you could be subject to digital services taxes in those countries. And we do expect that to rise. Why are tariffs important? We think the Trump administration is going to use tariffs as a tool, and we think that quite possibly some of these digital service taxes, Pillar 1, things like that could be on the table from a negotiation perspective. Like, well, if you're going to put a DST, a digital service tax in place, then you know what, we're going to hike your tariffs coming from your particular country to 25%. We think that kind of negotiation is potential, or at least on the table to be discussed based upon the new Treasury Secretary that's been nominated.
Yeah, so just to follow up on that, Brian, is, we've seen historically, especially Europe has had a lot of, conflict, I would say, with the U.S. big tech companies on trying to fight. There's been a lot of cases just to get that revenue. Just assuming this digital service tax is just another way that they're going to try to impose this, to get that revenue. So what countries in particular do you think you see? Is it all of Europe, or is it certain countries in Europe that you think will be more aggressive to try to get that revenue?
Well, I think you're seeing the political dynamics in the EU marketplace and the UK. I think it's across the board there, but certainly the big economies, Germany, the UK, France, I think you're seeing a lot of that they may propose digital service taxes. I think surprisingly, what you're seeing, and it's a wait to be seen, is that you're not seeing China and you're not seeing India move as quickly in this particular area. In fact, they haven't agreed to the to the Pillar One, because I think they are so nervous. I think you've seen recently in China that they are backing off. They've always been a big subsidy for their industrial base and their technology base, and then making the U.S. consumer benefit from it, but it takes away from our industries, the manufacturing and the technology. I think what you're seeing is that China is starting to have, at least they're putting it out there, we'll see, the idea of running deficits for the first time to spur domestic demand. And that could mean a lot for the US tech industry to serve into those marketplaces for the first time, because essentially that's what Trump wants to do, is like, look, we signed the WTO 40 years ago, and you countries have done everything in your power to do what I call end runs. Yes, you're legally in compliance with the WTO on tariffs and trade, but we all know you're doing end arounds on this deal to make it difficult for US companies to do business in your countries. I think that is what's really on the table here is, hey, countries, you need to spur demand in your domestic markets, and you need to allow the US to have access to your marketplaces. That's really what's on the table here.
Yeah, and we've been talking about just overall capital and expansion overall, both internationally and domestic. And there's a lot of conversations right now just covering just deregulation in the United States, and creating jobs, creating opportunities. We're starting to see more conversations about mega deals in tech, and maybe opening of the IPO market up a little bit more, which I would agree that a lot with that sentiment that there's going to be a lot more optimism for these things. Whether that comes to fruition or not, we'll see. But all that also has a impact, with deregulation, just with transactions on taxes there. So can you speak a little bit more about, how these M&A transactions will impact taxes, both internationally and domestic?
Yes, I think M&A activity in the tech space, if we do see this amount of deregulation and we do see a growth in M&A activity, I think the tech companies need to be ready to enter into that market space. And certainly, I'm trying to close 2 transactions this month, and the biggest issue on the table for both of them are taxes. And where is the IP located? Have you done your IP planning? Have you really, as fast growing companies, do you really know what your liabilities and your tax exposures look like? That is a big component. I know from an operational perspective, it's all about growth, and do we have the discounted cash flows? But certainly in this cross-border environment and having to take big purchase price discounts because of the tax exposures is a big deal that we're seeing in the tech space, especially right now from a deal flow perspective. And I don't expect that to change. And the other thing is, if we're going to do cross-border deals, what is the best way to structure those deals? You can get yourself, you company, taxpayer, can get yourself into a lot of inefficient structures if not properly planned on the acquisition. And sometimes it's not as easy to see that, we always talk about should be a stock purchase, asset purchase, how do we structure it? Who's going to take the exposure for the additional taxes? Well, certainly on an international basis, we're seeing the same thing. And I expect that to continue to occur. I would say how you finance the deals are also going to be very important. We saw in the last deal I did, we saw that financing was very important, and where you put the financing in the deal and the structure from a tax perspective is a very important thing, and not to think that you can just close a deal quickly without going through those elements.
Yeah, thanks for that. The other area that is Section 174. It's another major topic that's been already affecting small to mid-sized tech companies. And if you're not familiar by now, Section 174 is the required capitalization of R&D expenses that was effective a couple of years ago on that. And we'll dive deep more about that topic on another podcast because there's just a lot more to unpack on that. But for now, I wanted to thank you, Brian, for breaking down some of the issues as it relates to the global tax and what tech companies should be zeroing in on 2025. I know we recently published an article that goes into some of that, and we'll provide a link to when you're listening, and I'd encourage our listeners to just read that article as it goes into a little bit more detail of what those upcoming potential tax policies that we can expect in the new administration. So appreciate your time today, Brian, and we'll look forward to 2025 and beyond.
Absolutely. Thanks for having me, Michael.